all at once. I think that as long as there's a credible, strong plan over a period of time, and we move into that plan, that will achieve most of the objectives of fiscal sustainability, we need to at least avoid doing harm. I would say do no harm is an important piece of advice I would offer you. So there is a balancing act there that I think is important for us to pay attention to.
Thank you, Dr. Bernanke. And as you point out, those two goals are totally consistent. Sometimes they get muddled in the message, and I understand that sometimes people hear that, interpret the need to prevent doing harm to the fragile economy now as meaning we shouldn't move ahead on long-term deficit reduction. Of course we should, as you said. You can do things at the same time, but if you undermine the fragile economy, as the IMF, as you indicated, has warned is being done with certain fiscal policies in Europe, that just creates an even bigger hole. And as I, again, apologize, have to leave to go to the conference on the payroll tax extension, if you could just comment on whether or not failure to extend the payroll tax cut for 160 million Americans and whether failure to extend unemployment compensation for millions of Americans who are out of work through no fault of their own, whether failure to do that would be a drag on what is already very fragile economic growth.
Congressman, I know you appreciate that I don't endorse individual tax and spending policies. I think that's a good approach for me to take. Obviously, you need to look at the whole picture. I agree with what you said before, that you can't do one and not the other. You can't say, well, we got to protect the recovery, and therefore we, just completely put aside all of fiscal approaches to fiscal sustainability. You got to do both simultaneously, and you got to do both credibly. So I think it's the question of balance which is important.
Well, just to follow, as I look at your GDP numbers, your projected growth numbers, it seems pretty clear that they assume some extension of current policy, for example, an extension of some of the, at least through the end of the year, payroll tax cut. I'm not saying specific numbers, but there are differences between those and CBO, and CBO had to assume current law. They had to assume we don't extend the payroll tax cut, and they have to assume that all the tax cuts at the end of the year, including middle-income tax cuts, lapse. That's one of the reasons the CBO economic forecasts, GDP projections, are lower than yours. So I thank you, Mr. Chairman. I thank my colleagues, and I'm going to
just yield the rest of the time to Mr.
yield the time, and I think he also has maybe a little time of his own as well. So thank you, Mr. Chairman.
So just so members, he's leaving, so we're going to allow Mr. Doggett to finish his time, then we'll go back and forth. You hold the clock for him. Yeah.
Thank you very much.
Mr. Doggett. Yeah.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for your testimony. Just continuing along the same line of questioning Mr. Van Hollen was raising, Chairman Ryan has expressed some concern that under certain circumstances the Fed pursues a balanced approach. Do you believe that the Fed is having any difficulty in achieving the goals of both employment and price stability?
Well, I think it's evident that particularly on the unemployment side, we've like to see greater progress than we've seen. On the inflation side, I'm very cognizant of Chairman Ryan's concerns, but at least for now, we appear to be pretty close to target. I think what I would say about that is, of course, we're going to have to continue to evaluate monetary policy as the new data come in and as we see how the outlook changes and so on. But I've said before, and I think it's important to emphasize, that monetary policy can't do everything. It's not a panacea. And this body and others need to think about the troubled parts of the economy, places where improvements can be made in the tax code or in other areas. And so, again, to answer your question, we're obviously not satisfied with where we are, and we look to, and while we will continue to do all we can to meet our dual mandate, which is what Congress has given us, we hope that that all of you and the administration and like will look for alternative ways to strengthen our economy.
And you certainly have the capacity to recommend to the Congress that it alter that mandate if you thought it was interfering with the objectives of the Fed.
I think it's been, the dual mandate has worked fine. It hasn't, we have as good an inflation record as any other central bank. I don't think it's been a major problem. So I think it's served us well. That being said, Congress created the Fed. Congress gave us our mandate. If you determine that you want to change it, we will, of course, do whatever you assign us to do.
And you, of course, determine how to implement that mandate. And you've said, with reference to price stability, a goal of about 2% is your goal. And with reference to unemployment, did I hear you say 4.5 to 6%? 5.2 to 6%?
The difference, Congressman, the difference between inflation and unemployment is that the Fed can control inflation in the long run. We cannot control unemployment in the long run. That's determined by many other factors in labor markets and other policies that we do not control. So we can't set an arbitrary target, but what we can do is try to make our best guess of where the economy, what level of unemployment the economy could sustain over a period of time. And we don't have an official number, but the 5.2 to 6% is the central tendency of the estimates provided by the members of the FOMC.
And while we would certainly be delighted to be at that range today or at the end of this year, that's still a substantial amount of unemployment, isn't it?
Certainly. We have a very high level of unemployment. We have not come remotely close to replacing the jobs that were lost in the recession. We have a very high level of long-term unemployment. I think we all agree that unemployment and underemployment and people leaving the labor force and all those things are a serious problem. I mean, we may disagree about remedies, but the problem is certainly there.
Right. And all I'm saying is that the objective that you've set in implementing the goal, I think I have another.
You'll have another 5 after Mr.
Oh, okay. Let me just finish then on this one point, that the objective you set is not an overly demanding objective as far as employment, the 5.2 to 6%.
We'll let you answer that in his next 5 minutes. Mr. Garrett, just to keep.
Sure.
Mr. Chairman, thank you. So I heard your answer to Mr. Van Hollen before with regard, and you said, well, you normally don't like to give a comment on with regard to fiscal policy, in particular tax bills and the like. And I thought, really, Mr. Chairman? Is that still your opinion?
Yes, sir.
Because I was truly taken aback when just recently, as you know, the Fed issued an unsolicited white paper, if you will, on housing policy, where if you didn't advocate for, you certainly mirrored much of the positions of this administration. So I don't know how the two go together. On the one hand, you say you don't get involved in these areas, but here you had a white paper that was not solicited from us. I know you're protective of your independence, but when you advocate for a position like that, why would you issue such a paper when we don't ask for it?
Well, Congressman, first, the Fed has a lot of interest in housing. It's important for the economy. It's important for monetary policy. We are bank supervisors, so we're interested in mortgage and lending and unrelated issues.
So let me ask you this then. Congress has a lot of interest in monetary policy. I guess the comparable would be for us to do a House resolution with regard to monetary policy. Is this an invitation now to Congress that we should be issuing resolutions to what the monetary policy that the Fed should be doing? If so, I'm sure there's a lot of members who would like to engage in it.
Well, I hear lots of advice from congressmen. But if this, let me say, could I say the bottom line here, yes, though, is that we've done a lot of work on this. We've gotten a lot of requests from individual congressmen for our views and for our analysis. It was not the intent of that white paper to provide a set of recommendations. There was not a list of recommendations at the end of the white paper. We were trying to provide pros and cons, analysis, background. I'm sorry if you think we went too far, but we tried to provide useful information.
I hear that, but within 24 hours after that paper out, you know, the New York Fed president was out there basically advocating for some of the positions in there. Governor Elizabeth Duke was out there basically advocating for some positions out there. So you can't be on both sides of the issue where we're just saying this is what we think, and then the Fed president, the governor's coming out there saying advocating. No. And if it's because you're saying that members were asking your opinion, well, we were asking your opinion, and we would have certainly liked to have seen a white paper back when the president's colossal failure with the stimulus was going through, and we certainly would have liked a white paper at that time from the Fed to say just how that would have all worked out. Why didn't we see a white paper at that time spelling out whether this would work and whether you advocate or didn't advocate for the...
Well, again, I know you're skeptical, but we are trying very hard to avoid encroaching on Congress's fiscal responsibilities. With respect to the points you made about Governor Duke and President Dudley, they are not representing any official position of the board. They're speaking on their own recognizance. If you pay attention to the speeches that Reserve Bank presidents give, you know there's a wide variety of opinion, even on monetary policy. So there was no official endorsement of those positions. We are, again, trying to provide useful background. I apologize if it was misinterpreted. Again, our goal was just to be helpful.
Well, I guess I would just sort of take off of what the chairman was talking about. You have two mandates in the area of employment, the area of monetary policy, and that's obviously a lot for the Fed to be responsible for. We have a mandate in the area of fiscal policy, and we would like to retain that. Let me then go to another area. You do have a responsibility as the position that you have. Well, you're the owner of about $1 trillion right now of mortgage-backed securities, right? In that position of the owner, wearing that hat, can you comment then on the President's new proposal on the refi plan? What have you looked into that? What would the impact be as far as realized losses to the balance sheet if that plan was to go through?
No, we haven't done that specific calculation, and once again, I'm not going to endorse or not endorse a specific program.
What is the cost if we were to do that?
There are costs, as the President acknowledged. There are costs to it, and they would have to be raised somehow, whether it's from a bank tax or some other way. He mentioned $5 to $10 billion. We haven't looked at that number. We don't know if it's correct or not. There would also be costs to investors.
Right, and that's
including the Federal Reserve.
You're the investor in this situation. You bought these things, some would say, at a premium. So not the cost to the taxpayer, but your cost. Have you begun to look to see what your cost would be as the loss realized on those?
No, we haven't. Although we acknowledge, I think it should be acknowledged that that the rates of refinance have been extremely low, lower than expected over the last couple of years, and so in some sense that is reversing a gain that we got. But you're right. There are costs to the program. There are costs potentially to investors, and there's costs to the government potentially. So
that
yes,
would be one area that we would like to have a specific information back on, and also as a regulator, what the impact would be for the banks that you regulate, what the impact would be if you increase the fees on them. And I see my time is out, but I'd like for that information. Thank you, Mr.
Back
Chairman.
to Mr. Doggett.
Let me just return to the last question, and that is, many economists would think that unemployment of 5.2 to 6% leaves many people out there hurting badly in an economy, is a fairly substantial rate of unemployment, even though it's much, much better than where we are today. In setting your goals of trying to assure, to avoid excessive price instability and inflation, you have not taken a drastic position on unemployment. You've tried to have some, as you said, balance between the two, have you not?
well, we are not. There's nothing in our statement which suggests that we think that 5.2 to 6% unemployment is desirable or is a good outcome. We're just saying that given where the economy is today, that's what we think it can sustain under more normal conditions. There are many policies that Congress could consider, workforce skills and other things that might affect that long-run unemployment, and if that unemployment rate is changed, then we'll respond to that.
And on your estimates of what type of growth we will see in the near term in the economy that are in your testimony and the reports of the Fed, what assumptions do those estimates make concerning fiscal policy and where the Congress will be? I understand you're not getting into specific bills, pro and con.
Well, in order to make forecasts, we make guesses about what Congress will actually do. There's no endorsement or non-endorsement involved in that. Basically, the CBO presented sort of two kind of extreme proposals. One is the current law proposal, which assumes, for example, that all the tax cuts are ended and that the doc fix is not adopted and so on. And then there was an alternative scenario which sort of took the most
right. We had testimony about both yesterday.
Yeah, which assumed that there was no sequestration and that all the tax cuts were extended and you know, so it took the opposite approach. Our numbers obviously are based on an intermediate level, assumes that some of these policies are undertaken, but not all of them, and we try to make our best guess. But it's only staff guesses about what they think Congress may do, and I don't think those forecasts are, the details of that are particularly helpful to you. I mean, you obviously you're going to be trying to figure out what the right thing to do is.
With regard to an issue we've discussed when you've been here in the committee before on whether the policies of the financial community concerning rewards and compensation for taking excessive risk remain a problem, you've finally issued a report in October dealing with that. It indicated that there had been some improvement, but among the largest banks there continued to be a number of problems with regard to risk-taking and how that leads to rewards from some of those that are taking the risk with other people's money. Could you give us an assessment of what's happened since that report came out in terms of what progress is being made to deal with this issue that many of us are concerned could lead to another financial meltdown?
Well, the Federal Reserve undertook, even before financial reform was passed by the Congress, we undertook to look at this as a safety and soundness matter, and very early on we began working with the boards and the compensation committees of the major institutions to try to structure their compensation in ways that did not lead to more or excessive risk-taking. And I think, as the report suggested, we've made a good bit of progress. It's really sort of about that time of year when a lot of this information is finalized in terms of what the compensation packages are going to look like. We continue to make progress on that. We continue to work with the banks. I think that, as I said, I think that a lot of the major institutions have taken serious steps in this direction. I would point out, in addition, that beyond the actions that the Federal Reserve took independently, Dodd-Frank requires the Fed and other bank regulators to establish incentive compensation standards, and that rulemaking process is underway, and so that will augment and add to the guidance that we've already provided. So we have seen progress, and we continue to work actively with the banks to, I think in everyone's interest, to make the banks safer and reduce the risks to the taxpayer.
Does more need to be done?
Well, we continue to work on it. As we said in our report, we don't think that we're where we need to be necessarily, and I think that there's a lot of interesting questions. This is actually an active topic of academic research about how best to structure pay packages, what kinds of, what role should options and stock payments and so on play. So more does need to be done, but I think part of the process will be learning in our consultations with the institutions and with academics and others about what works best. And of course Europeans are doing similar things, and there's interchange there as well.